Hard Corner Podcast. I'm your host, Stuart Grundle. We're very excited to have our guest today, Trevor Wilson. He's the founding partner and CEO of Ridge Capital Investors. Welcome, Trevor. How are you?
I'm great, Stuart. How are you?
I'm great. Glad to have you. Excited to discuss a lot of your business pursuits today, as well as your perspective on what appears to be your favorite product type recently, office. And you can tell us more about your other history and your successes with the product that you've invested in over the years, and give us a little history on your background. You and I met, she's probably close to 20 years ago now, and in the multifamily side of the business. And you were active at SSR Realty Advisors, predecessor company to BlackRock Realty. So please tell us what evolved into your formation and start of Ridge Capital.
Well, thanks for having me. It's good to see you. I feel like we could spend a lot of time talking about your golf game, which would be more interesting, but I'm happy to talk about real estate if you like. But yes, you and I met quite some time ago in the early 2000s when it was a different time on a number of fronts. Cap rates were higher. I think I recall us building apartments with you and trying to solve for like a 8 cap or a 7.5 or something, and that was that was the target way back when. I'm sure you remember. But I've been a real estate knucklehead for 30 years, which makes me sound old, but you met me somewhere in the middle, and I've always been on the institutional side, or at least I was for most of my career, and had invested in all product types: apartments, office, industrial, some retail. Then I moved out to the Bay Area in '99, so I've been here ever since. And so I'd like to think I know the markets pretty well in those product types. Since you and I did business, I was at JP Morgan for a while doing the same thing, investing on behalf of separate accounts and bank balance sheet, believe it or not, and sort of more high octane stuff, mezz and development deals and what have you. Again, all product types. We actually did some hotels there too. Sorry. And then in the early 2000s, I joined a group called Broadreach, where we were a private equity fund where we were investing primarily in office. So I spent a lot of time honing my skills, if you will, in office, primarily West Coast. And I did that till 2011. And that's when, we all know that was a pretty tough time. The GFC was everywhere, and us real estate guys were all washing out left and right. And but it seemed like an opportunity to jump in and see if you could find compelling value. And so I left that firm and I started my own company called Ridge Capital. And the whole thesis was it being a compelling opportunity to buy at the bottom, and as long as I could find capital and compelling deals, that maybe we could make a go of it. It was in some ways harder than I thought it would be. In some ways easier than I thought it would be. It kind of just depended on the day, frankly. But I've been working with Ridge here since then. I have a team of 5 people, and we're active investors in value add office, as you said. We still do a bunch of apartments. We do some R&D and industrial, and we're really NorCal focused in our endeavors, but we're really looking for high teens, low 20s IRR sort of deals where we're really doing heavy lift. We don't develop. We're really just working with existing assets, trying to buy them cheaply off market where we can, create value at the operational level, and hopefully sell and make some money.
Nice. So I was always taught early on in my career, my first mentors is to pursue deals off market. And much easier said than done, as you know. And in your sector, in office, I don't know how that gets done unless it's a broken deal. And I'm just focusing on office right now, just based on your recent activity,
Sure.
keeping in mind that you've done these other product types. I've done a little bit of
Sure.
retail. I haven't done any office. Obviously, I'm more multifamily, but it's almost impossible to find deals off market unless you get a whisper listing coming up and you try to preempt it and that sort of thing. But that being said, that was one of the first things that my first mentor taught me. Tell me, when you're starting a company, I've met several professionals, successful professionals like yourself, in the last 20 years that have gone from the institutional arena to the entrepreneurial arena, i.e., starting up your own co. And I did the same thing. I didn't come from an institutional background, even though I had lots of exposure to institutional investors before I started my company. But you pivoted, and I don't think you took an institutional investor with you from one of your last institutional jobs, which is, maybe gray. I don't know what that's like. But, typically, like when I started my company, I went and used some known capital sources to do my first deals that I had done in my prior life as an employee slash junior partner. So, what compelled you to do this? And who would be your primary mentor that, if any, that you could point to along the way that helped you drive the start of your company?
Well, I had been thinking about doing my own thing for a while before I ultimately did it. Remember, again, it was the GFC. So from 2009 till 2011, when I started, everything we were doing was a knife fight. And it was a pretty tough slog. So, you'd come to work and you just feel like you'd get punched in the face a bunch of times and then go home and have to wake up and do it again. So, it was one of those times where, it was like, boy, if there's ever a time to want to take a risk and not have to do this every day and focus on new things, new opportunities, new excitement, new ways to make money, whatever it is that motivates you. And I had such a passion for investing in real estate. I just got, it was tiresome, if you will, to have to always focus on things that weren't working out because we couldn't refinance or what have you. So it was really just I was just inspired to try my own thing, and at the time it was pretty scary, right? I made the decision to walk out the door on a very friendly terms with no deals and no capital. Logic being the people I had worked with who I very much valued. I was not competing with them. I wasn't taking anything away from them. It was a very clean break, and I had hoped, and it turned out to be the case, that they would be supportive of the move, whether they liked me leaving or not. So I mean, that was really my approach. And in terms of, I guess, people that were advising me, there was no like one person, but I spent a lot of time talking to the folks that I had worked for in the past. So at JP Morgan and at SSR, and people that I really respected that were 20, 30
Mm-hmm.
years older than me and had been
Mm-hmm.
doing this forever. And I would ask them the question, like, am I being completely ridiculous? Like, should I just, weather the storm and get paid my salary and hope for brighter things? And, to a one, they were like, hey, look, like, if there's ever an opportunity, you need to go do it now. And if it doesn't work out, then you can deal with figuring out a salary later. But, why not give it a try? Just make sure. The key advice I got was, make sure you have runway, meaning that you have enough money to feed yourself and you have enough money to put into deals. Because if you don't have both those things, then you're probably going to fail and your wife's going to divorce you or what have you. So,
Right.
it was all about having some runway, right? The key word was runway. I heard it from everybody. You better have runway if you're going to start your own company. And the other piece of advice I got that was, equally as important was, don't go be one man in a pickup truck, because a lot of capital will not partner with you, because what if you get hit by a tree? You're their sponsor operator. If you fall off a cliff, then who's their sponsor operator? You better have a team. You better have, backup systems, all these things for, because institutional guys want to know that you're credible and they want to know that you're sustainable. So those were my main focuses. And slowly but surely we chopped wood and we were able to get some deals done along the way. And the more you do, as you know, Stuart, the deals beget deals.
Yep.
And we're kind of off and running. But it was hard, sure, scary.
And what year was that you LLC
11,
formation? 11. Okay.
11. Yeah,
And you were starting a family then as well, correct?
yeah, yeah. I had two little boys. And so some of my friends were like, "What are you doing? Seems like
And
a
that's
bad
the
idea." But
yeah,
the thing that I will say, and I've told this story many times, I'm very blessed. I have a very supportive spouse, and because like we all know how it works. Like it's a partnership, right? And if your spouse at the time says, "There's no way you're going to give up your salary. How are we going to like feed the kids or whatever?" But my spouse said, "You know what? If we have to sell the house and liquidate the 401k and whatever, I believe in you. You go get them." And she's like, "Well, I got to go get a job. I'll go get a job because I know you'll be successful." And had she not done that, I probably wouldn't have done it, right? So I think a lot of what Ridge is today is because Michelle was there to kick me out the door.
yeah. Well, I know at your wedding, I could have raised about 50 million that weekend with the people there. So you had a lot of supporters in the industry. And that's one of our commonalities. When I started my company, it was the same thing. I had two kids at home, little
Yeah,
toddlers, and another bun in the oven, and it
yeah.
just drove me. I assume it drove you as well.
Well, the
Then,
failure wasn't an option, right? Like, what were we going to do? I was going to jump off the cliff, and there was no parachute. Like, so I had to figure out a way to make deals because, remember back then, I mean, like it wasn't like I could just go get a job. I mean, maybe I could have, but it would have been really hard. It wasn't like a lot of people were hiring, senior acquisitions people, right? So, it would just failure was not an option. You had to succeed, and that'll
yeah,
motivate you.
yeah, no. So no, definitely. So when you started the company, and I always like to tell my employees when I started, similar size company when I started, um, was that the key was to get into what I call the deal flow. If you're in the deal
Yeah.
flow all the time, if you're just getting attention with deal flow, you can seek out pretty good opportunities. And ultimately, all we want are choices. If we have choices, we're in the driver's seat. So, how did you ascertain what that first product type was going to be, your first deal when you started?
Well, we were chasing office and apartments both kind of primarily. We did some of each early on. But you know what it was? Like and we felt like there was, just because if you remember, like values were depressed across the board, right? Almost
Yep.
no matter
Yep.
what you were buying. And so what we did was we spent time with the brokers that we knew the best. So the intermediaries that had some control over owners. And we could go to these guys who were like true friends, like you and I are, or whatever. Like I could go to them and say, "Hey, Mike, I just started a company. I need a deal.
Right.
Help me find a deal." And these guys were my friends and they wanted me to succeed. I mean, obviously they probably also felt like, if I succeed, it's good for them too. But, so we were just really pushing the relationships that we had built over 20 years to help us find deals. And we were saying, "Hey, look, if you help us find it, we'll pay you a fee. If you help us find it, well, you can sell it for us, whatever, or you can lease it for us." And just by getting sort of a team of guys or people working for us, we were able to really stir up a fair amount of deal flow. And then it was all about getting people to let you tie something up. Now, remember, like we started a company. I didn't have a capital partner. I was talking to people, but as you know, Stuart, like to really be in the game, you have to be able to control a deal. It's one thing to say, "Oh, I like that thing" or whatever, but you really have to control the deal to be able to then really chase capital efficiently. And what we ended up doing was these same brokers that really wanted us to succeed, and they would go to our, the prospective seller, and they would say, Trevor and his team, whatever, they're super credible. Yeah, yeah, they have the money. It's all good. You like, we should totally let them tie this up. Meanwhile, we didn't have any money other than, our couple shekels that we had in the bank. But,
Yeah.
we were able to tie some things up thanks to the relationships we had built. And that allowed us to then control deal flow and then be able to bring capital in. So that was really the key. It's all about the network and the relationships that you build over time.
Yeah. I want to touch on that in a second because you came from a capital allocator background into a
Yep.
entrepreneurial real estate background. So if
Yep.
I'm investing with you, just like you and I, our background is mostly high density urban development, or at least we should call it infill as opposed to
Yep.
suburban. I know you've done
Yep.
the resort hotel concept as well in one of your
Yep.
institutional stays, but
Yep.
we have an urban background, and obviously markets have changed.
Yep.
Prospecting's changed to suburbs and greenfield development and so on. So that being said, when you went out and you got your first deal, what was that product type?
Our first deal was an apartment deal, and frankly, I think apartments are easier to tie up, as you know, because the ownership is so much more fragmented, right? Apartments are owned a lot by private individuals,
Right.
whereas office buildings are owned primarily by institutional capital. So it's really hard to buy things off market from on the office side. I have done it, but it's just much, much harder. Whereas apartments, it's much, much easier, because you can throw unsolicited offers at Uncle Fred and Aunt Sally, as we like to call them, who have owned something for 30 years. They haven't raised the rents. They don't even know what it's worth. They bought it for 10, it's really worth 40, we offer them 35, and they almost fall out of their chair. And meanwhile, I've made $5 million on the buy, right? So
Yeah.
those were the kind of deals that we were chasing. And, so they were easy to get. And as I mentioned before, like deals beget more deals. Once we had an apartment deal or two going, people started to view us as being credible, right? Because you
Yeah.
were alluding to the fact that I had been at an institutional group. Well, I didn't have any track record as an operator. I had a reputation of being able to know how to buy things for somebody else.
Yeah.
But, so now we were building a reputation. And then our first office deal was actually an R&D deal came along because I had a capital partner that I had known, and they were like, okay, Trevor, we see that you're real. Let's go find something. We would rather have R&D in office, not apartments. So if you can find something like that, let's go get it. And it took us a little while, but after 6, 9 months, we found the first one of those down in San Jose, and the market was just recovering. We bought an empty partial two-story R&D building. We basically stole it. We fixed it, we leased it, we sold it in, I don't know, 24 months.
Wow.
More than doubled our investors' money. And so that was, the start of, now they wanted to do more deals, right? Because we
Yeah.
had a success.
Well, it's
So
great
that's it.
if you have a capital partner in tow, you have
Yeah,
ammo going to a battle. So, and you
for
obviously
sure.
need that. We get a lot of glad handing and small talk at industry events. So sure, I'll look at that deal, but having a strong handshake, so to speak, is what I like to call it in the past. Just like my relationship with some of your known partners and companies that you've
Yeah.
dealt with over the years. It's very reassuring. So in the GFC, the Great Financial Crisis, NOI was down 25% in San Francisco City. Peninsula 25%. I'm citing these numbers without notes because it was so painful. I remember all of it. So NOI is down, not just gross rents, NOI, and it's similar to what some of these markets are experiencing now. So that could create a buy opportunity. And the capital markets were a little bit erratic back then. So was that apartment deal an urban deal? Was it a suburban deal?
First deal we did was in Davis.
Davis, so suburban, so to speak,
Yeah.
but
Yep.
micro market, smaller sub market focused on students, correct?
Yeah. And then we bought in Brentwood. We bought a bunch in Sacramento. Like, so a lot of our stuff on the apartment side, actually all of it was suburban. I mean, this is a different topic altogether. We like workforce housing on the apartment side. And just like on the office side, we like multi-tenant. And workforce housing, we like it because that's the fat end of the demand spectrum, right? Those are renters by necessity. So we like that profile. I shy away from those sexy buildings you build, where you have to be at the highest rent in the market, right, to justify the return. And, I don't know if the renters are there or not until you don't know until you know. Whereas I like being at the place where, these folks are blue collar, lower end white collar. I want to provide them a good, safe place to live. And I know I can keep it full. Like, so those were the deals we're chasing. And on the office side, it's this multi-tenant stuff. So the two recent deals we bought in San Francisco that I can talk in detail if you want, but like those are deals where, we have 30, 40 tenants. And I love that because yes, it's more work, but the odds of me going to zero on occupancy are much lower than a single tenant deal, obviously.
Well, we're going to get
So like we like those plays.
we're going to break down those acquisitions, but I think it's impressive that you pivoted from urban investing to suburban investing, and your definition of workforce housing in the Bay Area or Northern California, the markets you mentioned were 110 to 140% of median, basically. So it's not an
Yeah,
age restricted thing that you're buying deals. It's just that's your index for your target renter.
exactly.
Yeah, which is excellent. And for you to go do that in Davis as previously a capital allocator and now an operator, you assembled a team to execute. Where there,
Yep.
I've always told people, and I've told my kids, when you're looking at people to go to work for, you want to be able to work for someone that's able to attract talent and retain talent. Uh,
Yep.
Not unlike a hotel company, a management company, definitely one of the property management company types that we deal with. That's what I look for first.
Yep.
Who's on your payroll? How did you attract them? Who's mentoring them? So tell us a little bit about how you assembled that team.
Yeah, I think I had learned early on from some of the folks I'd worked with in the past about pride of association, which sort of, I don't know, that sounds like a scientific term, but when you really think about it, like, are you proud to go to work with the people that you're associated with when you're standing in front of whoever, like a potential capital partner, and your partners are standing next to you? Are you proud to be with them? Are you embarrassed by them? Are they smart? Do they say the right thing? And I really took that to heart. So when I started Ridge, I teamed up with a guy named Brian Prince on the apartment side, who had a great reputation and knows apartments inside and out, and works his butt off nonstop, and had the same amount of experience I did. And I just knew that he was going to be a rock for me. And so I could lever off of him. And then we brought in, we have three other folks on our team that have been with us over a period of time, and we brought them in with, they didn't have lots of operating experience, but they were smart and they were hungry and they were motivated and they were loyal and they were diligent, and those were the things that I look for. And one of the things I'm most proud of is that in our firm, everybody that has come has stayed. And we don't have people that are like, I'm going to go somewhere else because they pay more, or the splits are better, or whatever. People want to be here. They believe in the family of Ridge, if you will, without being too cheesy. And that I think the sum is greater than the parts, right? I mean, I just think the value is really there. Like, we're able to lever off of each other pretty meaningfully, and that has been, a compelling piece of the whole story for us, I think.
So how long did it take for you to establish that platform wherein you had those associates, employees, and partners around you that you felt so good about to go attract new capital? Let's say when you and Brian might have went out with a nickel and a tin can and your hat in hand for the first deal, and then
Literally.
yeah, and we've all been there. And then subsequent to that, maybe a quarter or a year later, you've got three new teammates
Mhm.
on your
Yep.
team. Did that
Yep.
evolve with a deal or two, or were you deliberate in adding overhead and resources?
Yeah, I we had four people pretty quickly. And that felt like a good number, but it was kind of funny because we didn't have lots of fees to pay salaries. And so we all worked for free for, I mean, almost literally for free for a little while, until we got some fees. And my currency at the time was promote.
Mm-hmm.
So I could give these folks more promote than anybody else would, in return for the fact that I didn't have a lot of current income for them. And then when things balanced, then we could rebalance the whole equation. But really what happened was, we had people, we all liked each other and we all believed in each other, but really everybody saw the value proposition. They had a bigger chunk of the deal than they could put anywhere else. They knew that we were all going to work hard, all those things. So it was really like probably a year and a half before I felt like I had a really good team that was going to be there and sustainable. Um, but during that time that we were bringing the company together, it still felt like we had a good story. It's just, it didn't really, really click until we had everybody. So it was a year and a half or maybe two before we started getting it humming.
But you were collecting fees on a deal or two by then, so that was good.
Yes.
So you
Yes.
so
And
you knew you were on your way.
yeah, by year two, so we did, since we started Ridge in 2011, we've done 30 something investments. And I want to say like, after year two, we had probably already done like six. So we had some flow, we had some assets under management. So, there were things to do. And the crack up, I mean, you were doing this too. The crack up was, some of the things that we bought early on, we were flipping like a year and a half hold because the values were straight up and to the right almost in some cases because of where interest rates were. And the economy just really started to hum.
Yeah.
And so we were able to turn and burn. And the way it works for us, operator types, fees are great, but all that, they really just keep the lights on, right? And
Yeah.
so it's the promotes that move the needle for us. So we were able to harvest promotes, year two, year three, year four, year five. Like, so every year we were harvesting at least one or two. And so those, little buckets allowed us to do the next deal and the next deal, right? So you can see how the train really moves out of the station. And I think we were a little bit lucky because there were lots of tailwinds in the last cycle, so it allowed us to do that.
Definitely. And coming out of that GFC, there was a firming up in the multifamily market, you remember, in 2014, where everyone saw daylight at the end of the tunnel. And rates were
Yeah,
stabilizing, capital was flushing back in. There was a
yep,
huge pent up demand for rental increases, at least
that's
in the
right.
Bay Area markets as well as suburban and Northern California. And mainly, as you know, supply had shut down statewide. So you're in
Yeah,
California. You're not investing outside of California right now, correct?
we are not.
Yeah. So
Some
you
may
know the
some may
metrics.
question the logic of that, but but we're not.
Well, we can get to that. We can get to that later, but I understand. But the metrics were so good in California back then. Every other year, we were all beating down ballot measures from the crazy guy in L.A. Who was trying
That's
to
right.
rewrite rent control statewide, and institutional
Yep.
and private family owners were ponying up money to fight these ballot measures. But generally,
Yep.
there was huge tailwinds for the market, and capital formation became very robust. So with that, tell us, you touched on the R&D office deal you did in San Jose as an initial success story. That sounds like perfect in terms of going around the block in 24 months, especially when you're a new co. You've promised, or at least you've made representations to your capital partners. Hey, we could do this, and you did it. And so that was a success story. What was the next success story? And then with that, tell us about your best initial learning experience, either with deal, people, execution, whatever, early on when you got to those five key employee partners.
Yeah, so I think it probably wasn't the very next deal, but one of the early deals we did was in a market that you know and love. We bought a office building in Oakland, um, in downtown. It's called Latham Square. It wasn't a very big building. I want to say it's like 116,000 feet or something like that. But historic building, right at the intersection of Broadway and Telegraph. Like, so good location. It
Ton of tenants,
had
though, if
good.
I remember. You had so many
Yeah, yeah.
tenants.
Like, it was almost like office apartments, if you will, because
Right,
you had lots
right.
of tenants that were like 800 square feet. And anyway, so like what was really compelling about that deal was the market was still on its butt. And at that time, auction.com was the thing. I know it's called something else, but and people were actually buying product
Hmm.
through auction.com. And
Hmm.
so we bought that building. We succeeded and actually bought it through auction.com, which is supposed to be a
Wow.
blind auction, where the bank is credit bidding behind the scenes. You don't know it's the bank. You just see you bid X and then somebody bids X plus $10 or whatever, and you don't know if it's somebody else, it's the bank, it's whatever. But anyway, so we went through that process, and you're basically buying something almost without any diligence. You know a little bit, but it's not like a usual process where you have a month to figure it out and inspect it. You're basically closing your eyes and holding your nose and jumping in the pool. So we bought that for something like $100 a foot.
Hmm.
We knew it needed seismic work. We knew some of the tenants were no bueno. We knew we needed to lease it. And So we ended up doing a full seismic retrofit of that building with 55 tenants in the building. So we literally moved them around like Tetris blocks so that we could keep going up the building floor by floor with shear walls. We ultimately got done with that project after 18 months. Meanwhile, we did a lobby and fixed the bathrooms and started leasing space, putting Class A finishes in the. And we took the rents from 250 a foot full service to almost 450 a foot in 18 months, and we were able to lease the building up. I think we had it almost. I think we we're at like 85%, something like that, and we ended up selling it. I think 2 years into our hold period, maybe two and a half. So we were in it for I think 250 a foot. We sold it for 450 a foot, um, and obviously it ended up being a pretty compelling execution for us and our capital partners. But to answer your one question about things learned or how do you go about doing that with your team, the part that I thought really resonated and sticks with us today on all of our projects, office and apartments, is that we really developed a partnership with our architects, our general contractors, with the subs. They knew us, we knew them. Like people were giving us hams for Thanksgiving, kind of thing. Like we developed a rapport and there was that mutual trust. And so when it comes time to, hey Trevor, there's a giant change order, like we figured it out and they might eat some, I would eat some, whatever. And we developed this cohesive sort of network of execution minded people, and we took that from that job and we did it in the next job, which was we did some R&D in Pleasanton. It was the same kind of thing, bought it cheap, fixed it, leased it with the same team, sold it in 2 years. Took that same team and we bought two towers in San Jose, exact same team, blah blah blah, fixed it, leased it, sold it. That team is now working on 180 Howard in the city and 33 New Montgomery in the city. And like we're at the point now where I don't question the bids. I know that they're as good as I'm going to find. I trust my architects. And so we're able to not just move more efficiently, but we're able to go focus on uh, maybe the things that really make us money, like leasing the space. So I can have these guys help us figure out, what mechanicals do I need to fix? What do I need to do with the lobby? What do I need to do with like whatever?
Yeah.
And meanwhile, we're trying to generate revenue. So
Yeah.
it's almost like a third party partnership. So
Yep.
it's
And
been
you
a
did
good.
that. And, you're one of the few people that I've met and spoken to that have gone around the block and really crushed it in office in a difficult recovery period. Did you, when you were talking about Latham Square, did you know because of the nature of the sale via auction.com, did you have enough due diligence time to understand the seismic cost impacts?
Short answer is maybe. Like we knew that it was going to be like $10 million. I mean, we didn't know. Like we're like, okay,
You threw a
it's
number at it.
we're gonna, yeah, we're gonna spend somewhere between $0 and $10 million. We don't know what it's going to look like. We don't know if we're going to be able to do it, because our whole thought process on that was we bought it for $105 a foot through an auction process that was, I would argue, it was supposed to be really efficient. I would argue is completely inefficient because nobody wants to buy like that, sort of blind. And we just thought, worst case, we'll just put it back on the market and sell it for, I don't know, 120 a foot or something, because we can provide due diligence to somebody. So like we felt like the risk was low. And when we got into it, we realized there was probably more scope than we wanted. But like again, our basis was really low, so we held our nose and spent a little bit more than we wanted to, but ultimately created a product that people overpaid us for.
Yeah, but you had to throw a number at it and understand
Yep.
what you have to endure in a deal, and if it's a 2 year
Yep.
window or a 3 year window. It sounds like you
Yep.
got through it pretty quickly on the execution of the retrofit, but at the same time, you're trying to keep your investor happy and give them all the bad news surprise early. So
Yeah.
it sounds like there wasn't too much blood given there. It worked out fine.
No. Yeah. No. It worked out. And look, I mean, all this. I mean, it sounds like we're a genius or something, and that's not the implication. I think that the market was really healthy. Like there was a lot of tailwinds. Tenants, were jumping out of the city because Salesforce was taking all the available space, or whoever, and
Yeah.
Google and whatever, and going to Oakland, right? And so Oakland was on fire, right?
Right.
So the rent lift that we accomplished wasn't just because we made a pretty building. I don't know, maybe half of it was, but like, the market was really pulling up. So we felt like, well, we had to pay more than we thought, but our rents, 25% more than we thought. So, meh,
Yeah.
whatever.
Well,
you know?
as Tom Barrick once said at a talk I was attending, that you were riding the wave. So you had good
Sure.
tailwinds. The market was getting better. Oakland was getting that overflow. That's the market difference between Oakland and any other submarket in the Bay Area for at least for office, but certainly for apartments is we're always a discount to San Francisco. So you just
Yeah,
need to have enough job growth to drive all that, and you did.
that's right.
So and this is no slight against you, but I'm sure the owner of that building now is choking on it, not because of anything you did, but it's just the story, the way values have evolved and markets have changed, and of course Oakland is unique in that aspect as well.
Well, no, I can't tell you how many times I heard, during that cycle where again values just kept going up and up and up until they didn't. But
Yeah,
I would hear, well, nobody goes broke taking a profit, and we were sort of notorious for, and it was frankly my fault. We were notorious for arguably selling things early because my thought process, in particular on office is a timing game. What I don't want to do is get caught with it, kind of like a lot of people have in the position we're in today. And so we could have held that building. I think we sold it for 445 or whatever, 450 a foot. The next group sold it 2 years later for 700 a foot.
wow.
Okay? So I left, whatever, $250 a foot on the table, and people would be like, "Oh, you're kind of a dumbass." On the other hand, they're like, "Well, except for you made a bunch of money and your capital partner was happy, and you probably bought two more apartment deals with that money, because they trust you, and more deals beget more deals." And that's the way I looked at it. It was like, we left a lot of money on the table, but we made our investors money, and it allowed us to keep growing and to keep building, and all that. So I was okay with doing it.
Yeah, well, no one ever cut Mookie Betts' salary if he's hitting 60, 70 doubles a year with 110 RBI and
Right.
versus 25 home runs. So my point is doubles plus are always good. So that's a great segue to what you're doing now. So, I'm in the market for multifamily. I'm finding it difficult to buy existing deals because of negative leverage, perception on out of state markets. California, we could spend a whole nother session on, and hopefully we will in a subsequent podcast to talk about the crazy dynamics occurring in California across the political spectrum, population changes, socioeconomic changes, the whole gamut. But you're making a bet now on office in San Francisco. And the metrics right now look a little bit like back in 11 and 12 in terms of value erosion. But the new dynamic is this perception of potential doom loop in San Francisco. And your recent acquisitions were what I'm going to call the South Financial District. Would you qualify it as that?
Yeah.
Yeah.
Yep.
So and you've got a 30% vacancy rate, and I'm speaking broadly here across the market, and I think it's a little bit higher in south of in the South Financial District, Soma, straddling Market Street, so to speak,
Yep.
and some recent operators have called it the new AI corridor. So I'm
Yep.
really interested in hearing from you. Obviously, we can cite lease metrics, leasing metrics, and occupancy metrics, but you've literally got buildings with 300,000 to 500,000 square feet of available space based on what looks like just sublease activity, whether it's Salesforce abandoning a building on Fremont in terms of occupancy, Meta and Google have contracted. And I would, not knowing your business like you do, I would submit to you that they overexpanded too quick, too early in signing leases. So I kind of
Yep.
write that one off a little bit, like it's not a really big market indicator, but they were gobbling up space. So I look at these metrics and I look at available space, and you and I have talked a little bit about your acquisition. So clue us in on how you're going to overcome this vacancy rate, job growth. We can touch on all kinds of things. I'm a big daytime population guy. I like to do multifamily deals where not only is there a strong daytime population, but hopefully a nighttime population. So I've done like 5 deals next to medical centers because that gives me a built-in nighttime
Love it.
population, good or bad. They got to
Yeah.
go somewhere at night and hang
Yeah.
out, and it drives foot traffic and put eyes on the street. So tell me your methodology, and we can touch on the deals. Your recent one was 33 New Montgomery, fourth quarter last year. You did 180 Howard. I know that had a lot of unique uh, features to the acquisition. And then we can talk about a
Yeah.
couple of the recent sales comparables, which ironically don't differ a whole lot in per square foot acquisition costs. And I
Right.
chalk that up to they all have unique aspects to the deal, whether you've got an existing tenant guaranteeing rent and you got daylight at the end of the tunnel to take it to a certain threshold. Let's talk about that. So you did 180 Howard, and am I classifying that correctly? That it is in the South Financial District? I think I'm right, right?
Yeah. Yeah. It's over
Because
on
all
the
these,
Embarcadero. Um,
yeah,
yeah.
all these
It's,
all
it,
these markets, all these submarkets on these market reports keep changing. uh,
yeah.
Mission Bay.
That's
Did
great.
they even call it Mission Bay anymore?
Yeah, they
So
do.
they do. Okay. So 180 Howard, you buy this in the fourth quarter of 23. The State Bar Association was your seller, right? And occupant.
Yep. Yep.
So, I can
Yep.
say this on a podcast, but how often do you get to screw a bunch of attorneys? So hopefully, hopefully, hopefully you had a good
Uh,
time on this acquisition.
I think it was really the state of California that took it, but it's nice to have it be the other way for once. But
Yeah.
if I can just back up, so you're as you were setting the stage for the discussion, I think you're gonna laugh, but I think about early COVID, and I remember like I'm an entrepreneur, right? I don't have, 3 admins and all that kind of stuff. So, I think it was like April of 2020 when we finally got out of that first 30 days where you weren't supposed to leave the house or whatever it was.
Right.
I had to come into the office. I had like there was mail. There was I don't know. There were FedExes. Like I don't know. Sometimes rent checks come here, right?
Yeah.
So I drive into San Francisco, and this is not hyperbole. I literally think I was the only person in the entire financial district. I was the only car on the road. There were no cars anywhere. Anywhere. There were no people. And if you remember, the whole George Floyd thing was happening at the same time. So the windows were boarded up. Like all this stuff was happening. And it was like if there were tumbleweeds, there would be tumbleweeds. Obviously, there weren't in San
Right.
Francisco. I mean, it was quite frightening, right? And so you go from that moment and you go all the way through with obviously interest rates and work from home and then blah blah and then all the interest that we don't need to get into all of it. But as we sit here today, we have a market that's probably the most vacant it's ever been in its history. So call it 35% total availability, so including vacancy and sublease. And you would say to yourself, well, Trevor, why on earth would you want to buy when there's so much space? I mean, you're talking about something like 30 million feet that has to lease. That's a
Right.
lot of space when you do it
That's right.
5,000 feet at a time. And where is all this demand coming from? Well, the last cycle, Salesforce gobbled up everything. Google, Amazon, Meta, the big tech companies gobbled up all of the vacancies. So we were at 4%. When you're at a 4% office market, everybody's making a lot of money and the tenants are all paying a lot of rent. So here we are. Why would you do it? If you parse the numbers, which I think you have to do when you're really in the weeds as an investor, you really can't just look at the headline. You have to chop up the information. It's like you would with apartments. You're very like your medical office. You drill down to a neighborhood or a hard corner, right?
Mhm.
So if you drill down, the best buildings in this market are sub 10% vacant. People don't
Mhm.
talk about that, but they are. And the rents in some cases are higher than they ever were. Okay. So
So
flight
like
to quality.
would Transamerica
Yeah,
be a tower, an
Salesforce
example of that?
Tower, like
Yep.
yeah, One Market, Salesforce Tower, like those, the top buildings in the market, right?
Okay. Okay.
So that's pretty healthy. And what's happening? Those are tenants that believe in San Francisco, need to be in San Francisco, whatever, and their flight to quality, they're going to move to the best building, and they want views, they want whatever. So Embarcaderos, like all those, right? So then the next set of buildings, are roughly, let's say that's another 15 million feet or something. Like those
Hmm.
are the A minus, B plus. The vacancy is probably like 15%, 18%. And then like the next tier is like 35%. And then the worst stuff is like 80% vacant. Okay.
Hmm.
So if you take all the stuff out of the market that you or I don't want to invest in. So it's, C buildings, D buildings, stuff it's just was always garbage, frankly, right? Take that out of the market. So if you just focus on the best stuff in the market, I would argue I have a vacancy rate that I can kind of manage. And what we're seeing is that rental rates aren't really they have come down maybe 20%, but in the GFC they came down 60%. Why is
Hmm.
that happening? Well, it's because the better buildings are staying relatively occupied. There is leasing traffic. And by the way, construction cost has not come down. So if I, as your landlord, am going to build you space, the cost to build a space is actually more expensive than it was in 2019, or at least on par. So I can't give you a $40 rent when I used to get $80 because it cost me $200 to build your space. I can give you maybe a $65 rent, and tenants are taking it because they're like, oh, I get brand new space in one of the builder buildings for $65. Done. I was paying 80 for something not as good. So what we're seeing lots of demand in the 3,000, 5,000, 7,000, 15,000 foot space, but it's more musical chairs. Tenants are pulling up from wherever they were and going to buildings like ours at the moment where I can provide them capital. Because we have a new basis, I can give them money to build out whatever it is they want.
Hmm.
Okay. So, whereas there are a lot of buildings that have the old basis and they don't have any capital, they can't afford to give somebody TI. So that tenant has to just take in existing space and they don't want to do that. They want their own space. So what we're seeing is that we're actually seeing a lot of leasing activity. Like for example, in one of our buildings, I think we have 7 LOIs out right now for space. We have 2 leases in negotiation. We have 3 or 4 renewals. Like it's active. Like it's so people want to talk about how the market is, but it's already started to change. And what we believe, our bet was that people will want to come back to San Francisco. San Francisco was not going to be in a doom loop because it's too good of a city. There's too much capital here. There's too much, um, venture capital money that wants to be here. So our bet was we can buy as cheap as possible. We'll buy a 60% lease building. I just need to get it to 85% leased over 3 years. And in that time frame, as long as interest rates moderate and capital starts to come back into wanting to be in office, I'm gonna make money. That's my bet. So that
And
those are the bets that we've
we're
made.
not going to see any new builds to conflict with that strategy.
We,
No way. Other
we're
than we saw the Visa Tishman Giants deal, and I'm sure those were sweet, deals for the landlord at the time. I don't know
yeah.
if
Well,
they
they
were.
started construction in 2022 before interest rates went up,
Yeah, but they
right? So
2022 they were starting to experience the escalation in inflation for hard cost. So I'm sure the numbers don't sizzle. Put it that way. And
they did not.
the rent has got to be huge to make
Rent
it
is huge.
happen. Yeah.
Yep.
So that's interesting. Okay, so you pull all that back. I'm not a big advocate of downtown San Francisco only because I'm not active like you in that market. I don't see all the intrinsics that you just described, but you're better positioned, obviously, to do that than I am. So it's interesting in if you can break down one of these deals. You bought 33 New Montgomery recently. You bought 180 Howard. Out of those deals, what is the better story in terms of your execution? You described tenant size, having a tenant retention there, and being able to keep a building occupied. What's your game
Yeah.
plan?
Well, I think 33 New Montgomery, just because it's the most current, when we just bought it a couple months ago. I think I think it's probably the most relevant because I think it's how deals are going to go down for the next year or so. And what I mean by that is, so basically, we bought the loan from the lender, and we did a deed in lieu in a box. So the lender had already packaged the deed in lieu negotiation with their borrower. So we bought the note, and then I think 5 days later we did the deed in lieu with the borrower. So effectively, we took fee 5 days after we bought the loan. And in so doing, we avoid transfer tax. Thank you very much.
Mm, huge.
Which is meaningful, right? When
Yes.
you're talking about a 70, $80 million investment, right?
Yep.
So we did it that way. So there was that whole component. We also structured, and I don't know how prevalent this will be or not, but the lender that we bought the loan from, they carried back paper. So we did a 65% acquisition loan with them at 6% fixed IO for 5 years, non-recourse. And if you went to the market today to try and finance that same investment, it would be 65% at probably 10%, but 3 year term, floating, what have you. So, let's just say we picked up 400 basis points in cost on our debt. Uh, Now, what you would say, well, why would the lender do that? Well, the answer is because they wanted us to pay something really close to par on their loan. And so, therefore, they were juicing the value of their loan by giving us a new loan.
Was it marketed
Um,
that way on the street?
Not really. When it came down to round two, round three of of bids, it was offered up, and we
Nice.
took it. So
Yeah.
we bought the building at $307 a foot, 65% leased, in
Hmm.
place. I want to say it's an 8 cap in place, but with 6% debt, fixed IO. So our cash on cash day one is something like 11. Okay.
And that
So we
includes capitalized future costs for TIs and commissions.
the loan does not. So that's going to be all equity. I would argue that's probably the one negative, but at
Yeah.
65% leverage, we felt like when we put money in, we'll end up at 55 or whatever, right? Which is fine.
Yeah.
The thing that, aside from, maybe the yield and all that, but the quality of the building is excellent. It's an A- building. It's right on the corner of Market and New Montgomery. It has high visibility. It's always leased well. It's got a great window line. And the prior borrower had spent lots of money modernizing elevators, putting in amenity space, which you have to do now to lease
Mhm.
space in San Francisco. So conference facilities, facilities where you can get free coffee, free soda. There's a game room. There's a really beautiful gym in the basement, all free to the tenants. And so we didn't have to spend money on that like we normally do on our office investments. We basically bought a leasing play, high quality asset, buy it as cheap as you can. We just got to take it from 60, 65% to call it 85, 90 over 3 years, give or take, because we have tenants that are sticky. They're not all going away. So we have, a decent weighted average lease term in place. So we have stability of cash flow. Yes, we
Mhm.
have to put money into the space, but it's a building that leases well. And as I was saying, like, so that's the building. We have 7 LOIs out right now. And the thing for me, this is maybe just our investment philosophy, as you had pointed out earlier, there's a bunch of buildings that are actually trading or may trade, where you have to lease 400,000 feet of vacancy. I don't love that play because that sounds like a lot of leasing.
Does.
We have to lease our building's 240,000 feet, that one.
Yep.
I have to lease 60,000 feet in 3 years. Well, I feel very confident I can lease 60,000 feet in our current pace in a year and a half. It's not very much space. It's probably 8 tenants. Okay, so I got to do 8 deals. Maybe we get a few of these ones that we're working on, and we'll get a few more. So I just got to do 8 deals in 18 months for 2 years. I get myself to 85%, and now I have a stabilized asset that should have a meaningfully higher value than what I paid. And our bet, the ultimate bet, is the prior borrower was in it for $850 a foot. They
Hmm.
thought the building was worth 1,000 a foot. We paid 307. I just want to sell it at 550. I don't have to believe in the 850 or the 1,000. I just, something that's in the mid tier of where the values were last time, and we make money. So to me, it's not a heroic bet. Am I betting that there will be leasing? Yes. Am I betting San Francisco will not implode upon itself? Yes. I think those are reasonable bets.
And your loan's non-recourse to boot.
Non-recourse.
And just for the listeners' edification, this seller lender has done a similar structure on, I think, two multifamily deals in Oakland recently. And I would
Yep.
submit that the numbers on those multifamily deals affecting the lender seller are bloodier than what you just described on 33 New. Well, maybe not, but you bought it at par, the loan at 33 New Montgomery. So the multifamily deals are in Oakland were bloodier, but you've got a motivated seller lender. So your average tenants, your target tenant, 7,500 feet. Coincidentally, it appears to be, in just a couple of the market reports that I've scanned, that the average tenant size coming into the market this month or this quarter right now is on the smallish side. It's 7 to 20,000 feet. Obviously, there's some big whales out there kicking tires. There always are in San Francisco, as you
Yep.
know. So that strategy seems to be consistent with absorption. But one of the, again, playing devil's advocate here on your strategy, and I really want to be educated to this, is I follow these office occupancy rates through I call them attendance rates through Castle Systems, and
Yeah.
we've got a static attendance rate of slightly above 40% in San Francisco core for the past 3 years. So previous to that, it was obviously pre-pandemic. It was obviously a lot higher, but the last 3 years, it's static. What's happening there? What's going to bring back the nightlife? You got a new mayor. You've got the redo of the big portion of the waterfront between Embarcadero 4 and the Embarcadero. What's going to bring these players back to increase this daytime population and get people back into the office?
Candidly, first and foremost, I think it's the companies that are forcing their employees to come back. I mean, we see headlines almost every week that so and such and such is saying you need to come back. I think Uber announced today or yesterday. You got to be here at least 3 days a week. And maybe the norm is 3 days a week, or maybe it ends up being 4 days a week, what have you. And that's probably okay. So I think if you can get from 40% to, well, frankly, I'm not sure what it was at the peak because it's never 100%, right? So it was probably
That's
like
right.
70, right? Because people aren't there all the time, right? People travel and, whatever. So, I don't know what the right number is, but I think you can get somewhere close when a lot of these companies, wake up and they say, hey, for us to have culture, for us to build rapport, we're just better if we're all together. Now, what is happening that I think, as long as you have a new basis, like we're talking about doing, what's happening that I think is interesting and will speed this up is the new leases are different than the old leases. The old leases, people, what they would do is they would lease way too much space. They would have a whole bunch of amenities because they needed their people to come to the office, right? They want to motivate you to come to the office and stay. So they have a kitchen, they have, ping pong, they have like whatever, right?
Right.
Free coffee. And they have all this stuff, like this space for you to sit in the easy chair and type your memo or something. Well, now tenants are like, I don't want any of that. I want you to condense my space. I want you to provide me with conference facilities somewhere else in your building so I don't have to build it out myself and I don't have to pay rent on it. And I will have a very efficient, sure, there's open space, but I will have a very efficient box that you're going to put me in. I'll pay rent for it, but it's probably 65% as big as the last space I leased because maybe I have less people, but it's really, I'm not allocating as much square footage to them as I used to because I don't have to. Because Mr. Landlord, you're building me a gym, you're building me a bar, you're building me a whatever. And if you don't do that, I'm going to the next guy that's going to do that. So
So that,
that's really
yeah.
the arms race right now is building amenities in these buildings.
So that trend, is that open workspace, or there still POs on the private offices on the perimeters? Is it driving down TI costs for you a little bit? I know TI costs are skyrocketing in terms of inflation and labor still. Or what's happening on that front?
We are seeing more perimeter office than there was. We're still having open space, but people are going back to more of a perimeter office mindset as opposed to benches. And I mean, people
Yeah.
will still do the bench thing, but I think after COVID and all the other trends where people don't necessarily want to sneeze on each other, I think there's more of a spin to do breakout rooms, not big
Yeah.
conference rooms necessarily, but little breakout rooms, private offices, those little phone booth thingies that
Yep.
are really popular and expensive.
Yep.
So that's what we're seeing people
It's
doing.
interesting. That's it. So these elite common areas that you guys are building, these upgraded common areas, can you claw any of that back in CAM?
Yeah. So the way it works in office is that you have a load, right? So your usable space, let's say it's 5,000 feet, it's pretty standard for me to put a rental load on top of 20%, which may be actual. So that includes the corridors, the bathrooms, the lobby, the
Mhm.
gym, the conference room. So you're paying me rent on 60,000 feet, but you're really only occupying, or 6,000 feet, you're really only occupying 5,000 feet. And that's very normal. So as long as
Right.
you don't have already a massive load in your building, like because it's very inefficient or something, then you can add a few more percent because you took 5,000 feet and you turned it into a killer gym. And
Yeah.
so people are doing that all over the place. And I think it's the new norm. Like, I think you really have to do it. The other thing that we're seeing, and again, this is all about just trying to have the best line in the water, right? The best bait in the water. So to get tenants, because the market's, it's coming back. So you have to provide furniture. So a lot of these tenants want to plug and play. So for example, we built out a 17,000 foot space in one of our buildings. We made it look killer. It looks beautiful. Like, it's a really nice space. We spent $500,000 on furniture so something like, I don't know, whatever that is, 30 bucks a foot. Conference rooms, chairs, couches, tables, plants, you name it. And the tenant comes in and they're like, this is amazing. We'll take it. And we leased it. From the time we finished it to the time we had it leased was 2 months.
Wow.
And we had to swallow the fact that we uh, gave them $500,000 of furniture, but we technically own the furniture, right? But they're going to use it for 5 years. So it'll probably be all beat when we get it back. But anyway, like it's an inducement, right? It's another inducement. And rather than spending 30 extra bucks on, light fixtures and whatever, we built them nice space, but we put it in furniture, and that's what's leasing space right now. Those kind of
Wow.
things, amenities, furniture, plug and
That
play.
seems so personal. You have to do you bring a designer in and handhold the tenant and say, here's your A plan, here's your B plan,
Yep.
and get them to pick
Yep.
something, get them committed. Yeah, I would think.
Yep.
So, well, that's good. And of
Yep.
course, the designers will lower their fee to do that and work with you. And hopefully it's not Sam Clark furniture, but it's steel case or something like that.
Yeah. I mean, it's somewhere in the middle, but yeah, I mean, it's
Yeah.
nice. I mean,
Yeah.
it's nice.
Okay.
Yeah.
So you've got these acquisitions. You're in the South Financial District. We talked about office occupancy and attendance rates. And now the lavest buzz is with the 199 Fremont deal that Blackstone partnered with Divco. The metrics on that basically, Divco's recapping in essence a new purchase, but paying off CalSTRS at a discount just completely wipes them out. And they're buying in. Blackstone's buying in at a fraction of obviously way below a fraction of a cost of what the prior owner had capitalized their acquisition at. So, but they're spending that deal again. You pointed to large spaces. They've got, I think it's what 400,000 feet there vacant.
That building is completely empty.
Yeah, and it got notoriety probably because of Blackstone, less about STRS taking a haircut, but more about Blackstone coming back to the market, and then it's being sold for over $100 a foot, or I'm sorry, over 100 million. So the fact that it's selling over 100 million was some kind of watershed moment in the trading history here, going back 12 months or at least in this cycle. So I look at that, and they're dubbing it now the AI corridor. So what's your opinion on tenant profile, tenant type, industry that's going to drive this? And it's a good segue to your prediction for the San Francisco market in terms of cap rate trends, market trends, and stabilization in the market. Tough questions.
So I'll just say on that deal, I actually think it's a good buy. They paid 265 a foot for, a true A building, but it's a building that really is dated in the interior because it hasn't really done a second gen turn, at least not that much. So when you step back and you look at their basis, they're going to have to re-tenant all the space, minimum 150 a foot, not counting commissions, I think. So let's just say, make it simple math, 175. So they're going to be in that thing for mid 400s a foot, not including carry. And I would say that's pretty good, right? But they have to lease a lot of space. So the basis, while 265 sounds really good, you're still going to end up mid 400. So, it's not like they're totally stealing it. But I think the most compelling piece of that whole story is that Blackstone is in the market. We have seen time and time again, kudos to those guys, when Blackstone calls the bottom, people listen.
Right.
Now, whether they're calling the bottom there or not, I don't know, but it's their first play that we're aware of in San Francisco, at least of size. And I think that sets a tone for many of the closed end fund guys that, kind of all follow in the same path as, the Blackstones of the world, that maybe it's time to start looking at buying office buildings again.
Yeah.
And so that to me is really the shift that is an inflection point for this market to date, including our deal. Our capital was a high net worth, a family office. Okay. It was not institutional. Our deal at 180 Howard was, we syndicated it. Okay.
Mm-hmm.
Not institutional. A lot of the deals that have occurred so far in San Francisco are private capital or quasi private capital. They're not closed end funds. We're now starting to see the trends where we're talking about closed end funds, hedge funds that are coming in and they're going to take down space. I think there was an article even like a couple of weeks ago about all these billionaires coming in and buying buildings, and that's what the trend's been. Well, those guys always come in early and leave early, and then the Blackstones and the whoever of the world, MetLife's or whatever, will come in and the market will run. And so we think the market's about to run. We think that there's enough leasing momentum that people are willing to make a bet. I think if it was super quiet still, people would be really skittish. I think with the new board of supervisors, with the new mayor, who's very business oriented, and I truly believe he's going to make a difference. I think people are more willing to make a bet, especially at the basis that we're at. And there's now going to be a couple buildings that are about to hit the market that I would argue that are trophies. So 45 Fremont, 55 2nd Street, and there will be more right behind it that are genuinely trophy assets. And
Right.
those will be the ones where I think you're going to, instead of getting 5 bidders, you're going to get 20 bidders. And it's going to be the institutional guys primarily because the check's bigger. And I think those are where people that are sitting in wherever, Chicago, New York, Miami, wherever the investment committee is, and they're going to go, hey, did we already miss the window in San Francisco? Did we miss the bottom? And so I think there's going to be some pressure for some folks to play because a lot of these guys raise so much money, and I believe they have to invest in office at some point because they just cannot get all that money out buying apartments and student housing and, industrial as a service and outdoor storage, or, they just can't. Like, you need to put $100 million at a time out on big office checks. You just do.
Well,
Like,
they
that's how
can do
it's,
that unlevered. And as you described, the debt
yeah,
markets right now, and some of my good friends in the business are bitching about the effects of Liberation Day and the destabilization of capital markets. I would submit that's going to stabilize, but the 10-year has been really jagged here, trailing 30 days, but it's not plummeted. It's still
yeah,
trending upward. So that's not good for debt. So your acquisitions and your associated capital formation was very unique to be able to compete. So I agree with you. I always use this as a barometer when someone like a Blackstone comes in, and I pitch it like in the East Bay. When Walnut Creek and Oakland got their first big institutional investors, I was on my burner accounts on formerly Twitter, just prodding the politicians to wake up and keep getting that kind of capital. You can only
yeah.
imagine what I'm saying now on my burner accounts to those same politicians for capital flying away from those markets. So it's great you're right. And I did listen to a podcast a couple of weeks ago with Jonathan Gray saying how he was tiptoeing back into the office market, and it was very encouraging that he included San Francisco, obviously, and having a blue chip partner like Divco as well is a good
Yeah.
thing. So, and did these things translate to cap rates? I know they're all unique because
Yeah.
of
Sure.
capitalized cost carry, but generally, what would you target the cap rate on these product types right now on office?
In 2019, I would say that folks were looking to stabilize an office cap somewhere between 6 and 7 stabilized. I think today, well, I know today that people are buying 60% leased office buildings at a 10 cap. So at 60%, it's a 10, not stabilized at 10. Okay.
Hmm.
So you had
So
a
that's accounting.
pretty,
That's accounting for these terrible new taxes. And we could spend a whole episode on insurance. I won't even go there.
yeah, let's not.
I assume it's still high for office as it's decimating for multifamily in
Yeah.
California. So you've got all
Yep.
these capitalized, you got these operating expenses that you've included. Then you have your capitalized cost, and you're including what's a normalized vacancy? 10 to get to a 10% cap
Yeah.
rate. Okay,
Mhm.
so you've got
Yeah.
a 90% occupancy to get to a 10%. I'm sorry,
Yep.
you had a 60% occupancy to get to a
Yeah,
10%.
so we're buying. So we bought, for like I told you, we bought an 8 cap at 60% on 33 New Montgomery. So at
Mhm.
that number, we believe we stabilized to a 12.
12.
Okay,
Okay.
so I think people are looking to stabilize between a 10 and a 12 today, whereas before it was a 6 to a 7. And I think most people are willing to underwrite an exit cap between an 8 and a 9, whereas before they were underwriting a 6 to a 7, somewhere in there, 6, whatever.
So
So I,
you're cutting the normal profit margin four to 500 basis points. You're cutting it in half to be conservative on your outlook.
right. So I think that if you can buy an office building today that you think will lease at something with cash flow, so it's a high single digit, stabilize at least stabilizing to a low double digit, so let's call it a 10, 10, 11, 12, and you believe you can sell it for an 8. If you, I just run that math on almost anything, I'm going to make money.
Yeah, but you want to make good money too. So that's interesting. That's
Well, you
very
have to
interesting.
because capital's too efficient, right? So capital's not going to take the risk without feeling like they're getting an outsized return. So if I go to like 2019 again, I think people were buying office buildings and hoping to get somewhere in the low teens IRRs.
Hmm.
Today, for an office deal levered, you have to be low 20s, unlevered, high teens. So unlevered, like an 18, is
That's
what people are
robust.
saying.
So what's leverage? 60 when you're doing the high teens to 20
Yeah,
for office?
like
Okay, so
60%.
you got
Yeah.
60% debt. So that's
You
amazing.
can do 65. I mean, you could do more, but and the cost today is SOFR 450 to 500.
Wow. So that's 150 basis points above stabilized multifamily. It's 100 above Class B multifamily for spread on the SOFR rates.
I gotta tell
Yeah.
you, like right now, I think the hedge fund. I mean, well, the latest Trump effects aside, I mean, I think you can do value add multis at 65% at SOFR 250 right now.
Yeah. Yeah, I believe that. We've got a property in the mountain states that's SOFR sub 300 stabilized, 6-year old
Yep.
property value add. So yeah, that's a
Yep.
big spread. So you gotta move the needle on these offices to get to those returns. So that just to kind of in closing, what is your prediction in terms of other target markets evolving like this, where you can seek those kind of returns? Are there any target markets that Ridge and you are pursuing right now?
There are indeed. We believe that San Francisco leads the charge in this market, aside from like, maybe the Palo Altos of the world or something. But, we believe that for, larger office investments, San Francisco really is the bell cow. And so we invested in here earlier than some, and we're going to keep investing for a little while. I think we could probably have a 12-month window before values get away from us.
Hmm.
In the meantime, we are now starting to spend a lot more time looking at the peninsula and the valley, a little bit in the East Bay, And the rationale there is San Francisco for the last 6, 12 months, capital extremely difficult. Now it's getting easier, like we've just spent time on. Getting easier and easier. More and more people are willing to play here. If you go to suburban markets, buying office in suburban markets is like a year ago, where it's very difficult to get capital to play. There's some exceptions to the rule, but generally speaking, to get a capital partner to play with you on value add multi-tenant office is like a unicorn. So we believe that the next play for office is to go buy the best building you can get in a good market. So I don't know, Redwood City, pick a Mountain
Yeah.
View, Sunnyvale, Santa Clara, San Jose, whatever. You're gonna make your bets. But like if I can buy the best building, second best building in that market at similar discounts, so I'm 30 cents on the dollar, 40 cents on the dollar, it won't be 300 a foot, it might be 225 or whatever. And I can get the same returns. I can buy for somewhere between an 8 and a 10 at 60%, and I stabilize to a 12. That's going to be the next wave of deals, because I think people will start to feel priced out of San Francisco pretty quickly here. And so we're spending a lot of time looking at suburban.
So will that wave extend beyond the 12 months that you mentioned for the window? Hard to
Hard
say.
to say, but I think 12 months I think 12 months from today, barring some shocks from Washington, I think we're going to look back and say, oh, wow, the best I can do here in San Francisco is 450 a foot.
Okay. And just in closing, you're not seeking any opportunities in SoCal down to the San Diego, correct?
We're really NorCal guys, and it goes back to sort of the original premise. When we started the company, we wanted to be local sharpshooters. We felt like the best way to aggregate and attract capital was to be the best in the neighborhood. So like you, and I know this about you, like, every street, every corner, every, like, whatever, like, we try to be that. Like, so we can go to capital and say, yeah, we've looked at this building 6 times and we know who's next to it and we know what, blah, blah, blah. And so that's really our play. And like the reason why I think just being constrained to one geographical area works for us is because we do office, we do R&D, we'll do a little bit of industrial, and we do multi. So we have enough product types that we can source enough deal flow.
That's great. Okay. Well, folks, Trevor Wilson, Ridge Capital, active, probably the most active player right now in San Francisco, picking
I don't
off
know,
deals
but
and
we're
clearly in the
excited about it. Yeah.
deal flow. So, Trevor, your handicap. This is interesting. You did 30 deals since the inception of the company. I knew you when you started the company. Knew you very well. We used to play at the same golf club. You had a high handicap. Now your index is very low after doing 30 deals. We could spend another 10 minutes on another episode to talk about that, because I can't do that. My claim to fame was when I had our first child, I got over 100 rounds, but that was easy. You play 4 hours, you let the wife get a break for 4 to 5 hours. But my index has gone up. And I haven't done 30 deals since 2011. I've done a lot, but not like you. So how does that work? So we're going to touch on that next time. I'm just goading you because
it's all about wanting it. You got to want it.
and,
You got to commit. You got to spend some time.
Well, I would tell you probably got some pretty good balance in what's going on in
Right.
your life right now. And it sounds great, and very happy for you, and a great story here. And thanks to all of you for joining the Hard Corner podcast, hosted by me, Stuart Crundle.